Imagine your household budget. You earn money, you spend money. You might have a steady income from your job, and you allocate that income to various expenses like rent, groceries, utilities, and entertainment. Sometimes, you might even save a portion of your income for future needs or emergencies. Sometimes you borrow money to buy a house or a car. This borrowing is often in the form of loans or mortgages, which you agree to pay back over time with interest. These loans allow you to make significant purchases that you might not be able to afford up front. Now, imagine the U.S. government's budget. It collects taxes from individuals and businesses, which forms its primary source of revenue. These taxes are used to fund various public services and infrastructure projects. It spends money on things like defense and healthcare. This includes funding for the military, public health programs, education, and social services. The government allocates its budget to ensure the well-being and security of its citizens, and just like a household, it sometimes borrows money. This borrowing can be through issuing government bonds or taking loans from other countries and financial institutions. The borrowed money helps to cover budget deficits and finance large-scale projects. This borrowing adds up to the national debt. The national debt is the total amount of money that the government owes to its creditors. It accumulates over time as the government continues to borrow to meet its financial obligations. To understand if the debt is a problem, we look at the debt-to-GDP ratio. This ratio compares the country's total debt to its gross domestic product, GDP, which is the total value of all goods and services produced within the country. GDP, or gross domestic product, is like the country's total income. It represents the economic output and overall health of the economy. A growing GDP indicates a thriving economy, while a shrinking GDP can signal economic troubles. The debt-to-GDP ratio tells us how big the debt is compared to the size of the economy. A lower ratio suggests that the country can manage its debt effectively, while a higher ratio may indicate potential financial stress. If the ratio is high, it means the country owes a lot of money compared to what it earns. This can be concerning because it may limit the government's ability to invest in future growth and respond to economic challenges. This can be a warning sign for the economy. High debt levels can lead to higher interest rates, reduced public spending, and increased vulnerability to economic shocks. Think of it like having a large credit card balance compared to your salary. If your debt becomes too large relative to your income, it can be challenging to make payments and manage your finances. It might be manageable for a while, but it can become a problem if it grows too large. Just as individuals need to manage their personal finances responsibly, governments must also ensure that their debt levels remain sustainable to maintain economic stability. The U.S. has always had some level of debt. It's how governments finance projects and deal with emergencies. After World War II, the debt was high, but the economy boomed, and the ratio went down. However, in recent decades, the debt has been steadily increasing. The reasons are complex, including tax cuts, increased spending on social programs, and the wars in Iraq and Afghanistan. This trend has accelerated since the 2008 financial crisis and the COVID-19 pandemic. The government borrowed heavily to stimulate the economy and support businesses and individuals. There are several reasons for the increasing debt-to-GDP ratio. One factor is lower tax revenue. Tax cuts, while popular, mean the government collects less money. At the same time, spending on entitlement programs like Social Security and Medicare has grown as the population ages. Additionally, the U.S. spends heavily on defense, more than any other country in the world. These factors, combined with emergency spending during crises, contribute significantly to the rising debt. It's important to note that not all debt is bad. Borrowing to invest in infrastructure, education, and research can lead to long-term economic growth. However, when debt rises faster than the economy, it can become a concern. Section 4. Living on borrowed time, the risks of a high debt burden. A high debt-to-GDP ratio poses several risks to the economy. When a country accumulates a significant amount of debt compared to its GDP, it can create a precarious financial situation that affects everyone. First, it can lead to higher interest rates. As the government borrows more, it competes with businesses and individuals for loans, driving up the cost of borrowing for everyone. This can make it more expensive for people to buy homes, start businesses, or invest in education. As the government borrows more, it competes with businesses and individuals for loans, driving up the cost of borrowing for everyone. This increased competition for loans can stifle economic growth and innovation, as businesses may find it harder to secure the funding they need to expand and hire new employees. Second, a large debt burden limits the government's ability to respond to future crises. If another recession or emergency were to hit, the government would have less capacity to borrow and spend to mitigate the damage. This could lead to prolonged economic downturns and increased hardship for citizens. If another recession or emergency were to hit, the government would have less capacity to borrow and spend to mitigate the damage. This lack of flexibility can be particularly damaging during times of crisis, when swift and decisive action is needed to stabilize the economy and support those in need. Third, a high debt-to-GDP ratio can erode investor confidence in the U.S. economy, potentially leading to a weaker dollar and slower economic growth. When investors lose confidence, they may seek safer investments elsewhere, reducing the inflow of capital into the country. It can also create pressure to cut spending on essential services or raise taxes, neither of which are popular options. Cutting spending on services like education, healthcare, and infrastructure can have long-term negative effects on the country's growth and well-being. Raising taxes, on the other hand, can reduce disposable income and consumer spending, further slowing down the economy. Section 5. Tightening the belt. Potential solutions to America's debt problem. Addressing the debt-to-GDP ratio requires a multi-pronged approach. One solution is to increase revenue through tax reforms that ensure everyone pays their fair share. This could involve closing loopholes, reducing deductions, or exploring new sources of revenue. Another solution is to control spending. This doesn't necessarily mean drastic cuts, but rather smart spending that prioritizes essential services and invests in areas that promote long-term growth, such as education and infrastructure. Finally, fostering economic growth is crucial. A growing economy generates more tax revenue and makes it easier to manage the debt. This requires policies that encourage innovation, investment, and job creation. Section 6. The Path Forward, Shared Responsibility for a Sustainable Future. The issue of the U.S. debt-to-GDP ratio is complex and requires careful consideration. It is not just a matter of numbers, but a reflection of our economic health and priorities. There are no easy solutions, and any approach will require difficult choices and compromises. Balancing the budget while ensuring economic growth is a delicate act that demands strategic planning and foresight. However, ignoring the issue is not an option. The longer we delay, the more challenging it becomes to address the growing debt and its implications for future generations. Addressing the debt requires a long-term perspective and a commitment to fiscal responsibility. This means making tough decisions today to ensure a stable and prosperous tomorrow. It also requires honest conversations about the trade-offs involved and a willingness to work together to find solutions. Collaboration between different sectors and stakeholders is essential. Ultimately, the responsibility for ensuring a sustainable economic future for the U.S. lies with both policymakers and citizens. Everyone has a role to play in shaping policies that reflect our collective values and goals. By understanding the challenges and working together, we can find solutions that promote economic growth and opportunity for all Americans. It is through shared responsibility and collective action that we can build a sustainable future. Conclusion. The U.S. debt-to-GDP ratio is a complex issue with no easy solutions. However, by understanding the factors driving the debt, the potential risks involved, and the possible solutions, we can begin to have a more informed conversation about how to address this critical challenge. It is through thoughtful dialogue, responsible policymaking, and a shared commitment to fiscal responsibility that we can secure a strong and prosperous economic future for the United States.